Imagine a hidden switch that controls billions of barrels of oil, the largest reserve in the world. And in early 2025, someone flipped that switch, just a little. That's exactly what happened. Quietly, without much fanfare, a shift in U.S. policy changed how Venezuelan oil can move through global markets. Now, this wasn't a full reversal, and it definitely wasn't a dramatic, sweeping announcement. But it was enough. Enough to redirect money, redirect barrels, and change the incentives in ways that are very likely to affect your fuel prices within months. We are talking about a country that is sitting on more than 300 billion barrels of proven oil reserves. Think about that number, 300 billion. That is the largest in the world. Larger than Saudi Arabia, larger than Russia. And for years, much of that oil has been what we call economically stranded. It wasn't stranded because it didn't exist. It was stranded because it was legally and financially constrained. It was restricted by sanctions, blocked from normal trade channels, and simply unable to reach global markets at scale. That constraint, that wall, has now been partially loosened. This isn't really a story about personalities or politics, at least not the usual kind. This is a story about an oil system that completely collapsed, then became financially locked, and is now being selectively reopened. And when oil supply conditions change, the effects always ripple outward, into global prices, into the valuations of every major energy company, and most importantly, into your household fuel costs. By the end of this video, you will understand exactly how this new shift works, where the money actually goes, and what this development means for you in practical economic terms. Let's follow the money trail. Venezuela was not always associated with economic collapse and crisis. In fact, for much of the 20th century, it was one of the wealthiest countries in all of Latin America. The reason, of course, was oil. Venezuela has been a major oil producer since the early 1900s. By the 1970s, it was pumping out more than 3 million barrels every single day. It was a founding member of OPEC, the global oil cartel, and at one point, it actually had a higher per capita income than several European countries. It was often described, and accurately so for a time, as the Saudi Arabia of the Americas. But economies built almost entirely on one single commodity are incredibly fragile, and Venezuela, unfortunately, made a series of compounding mistakes. The oil industry was nationalized, and the state oil company was increasingly used as a political instrument rather than being run as a commercially efficient enterprise. Experienced engineers and managers were systematically dismissed and replaced with political loyalists. Investment in infrastructure dried up, wells went unmaintained, equipment degraded, productive fields were totally neglected. When global oil prices fell sharply around 2014 and that entire system completely unraveled, oil production plummeted from more than 3 million barrels a day in the late 1990s to under 700,000 by 2020. That is a decline of roughly 80%. Government revenue collapsed. Currency issuance accelerated rapidly. Inflation spiraled out of control, and millions of people were forced to leave the country in a massive migration crisis. But one critical fact remained totally unchanged. The oil itself never disappeared. More than 300 billion barrels are still sitting there underground. It remains the largest proven reserve on Earth. The limiting factor has never been the geology. It has been governance, mismanagement, and restrictions on financial access. Even if the physical production capacity could somehow be rebuilt, another barrier remained firmly in place: international sanctions that severely restricted Venezuela's ability to sell its oil through mainstream financial systems. That, in short, is the oil empire that collapsed. And that is the system that has now been partially adjusted. To fully grasp why this recent policy change matters, it is vital to understand how sanctions actually operate in practice. Starting in the late 2010s, very broad restrictions were placed on Venezuela's oil sector. The primary objective was to limit the government's revenue by restricting who could legally purchase the oil and exactly how payments could be processed. In practical terms, this meant several things. U.S.-based companies were completely barred from buying Venezuelan crude. Refineries along the Gulf Coast, which had been designed specifically to process Venezuela's heavy oil, had to scramble to seek alternative supplies. Non-U.S. companies faced a stark trade-off: conduct business with Venezuela and risk losing access to the secure, dollar-based financial systems, or simply avoid Venezuelan oil altogether. Most of them chose to avoid it. Access to global banking, dollar clearing, and major markets was far more valuable than any discounted crude they could buy. This shows how modern sanctions exert their pressure, not through physical blockades, but through controlling the global financial infrastructure. As a result, Venezuela's export volumes fell even further, and government revenue continued to decline. However, oil production never stopped entirely. Sales continued through limited, often murky channels, primarily to buyers willing to accept legal complexity and heavily discounted pricing. Much of this oil flowed to non-Western markets. At the same time, the ownership of the revenue itself became legally contested. Multiple parties laid claim to Venezuelan state assets held abroad. Bondholders pursued repayment through courts. Companies with expropriated assets sought compensation. Any payment tied to Venezuelan oil sales risked being frozen, challenged, or immediately redirected. This created what economists call stranded wealth, value that exists physically, but simply cannot move freely through legal and financial systems. That is the structure that was recently modified. So, what exactly changed? In early 2025, limited licenses were issued allowing certain Venezuelan oil transactions to resume, but only under very specific, strict conditions. This was not a full removal of restrictions, but rather a set of narrowly defined exceptions. Under these licenses, select refiners and companies are now permitted to purchase Venezuelan crude within tightly controlled parameters. Why is this important? Because many refineries along the U.S. Gulf Coast were specifically built to process heavy crude, which is exactly the type Venezuela produces. When access to that supply was cut off, refiners were forced to turn to alternative sources that were often more expensive or simply less efficient to process. Restoring limited secure access can immediately reduce input costs for these refiners, and lower costs, under the right conditions, can sometimes translate into lower fuel prices at the pump for consumers. There are broader implications here too. First, even a modest increase in effective available supply can help place a gentle downward pressure on global oil prices. Second, rerouting this oil through monitored, legal financial systems reduces the reliance on opaque intermediaries and discounted sales. Third, partial access creates a powerful form of leverage. These permissions can be expanded, limited, or withdrawn entirely based on compliance with the stated conditions. This structure is intentionally incremental, designed to influence behavior and slowly pull Venezuela back into the mainstream without fully reopening the gates. But here's what could backfire. First, let's consider the idea that just because a country can export more oil, it means more oil will actually hit the market. A lot of the time, the infrastructure needed to produce and transport that oil, pipelines, terminals, refineries, is old or damaged. Without new investment to fix it, production can't just ramp up overnight. So, even with a green light to sell, the actual amount of new oil might be a trickle, not a flood. If that's the case, global supply barely changes, and prices at the pump, they're not likely to move much either. The big benefit we were hoping for just doesn't show up. Second, there's the issue of uncertainty. When a government changes the rules on energy exports, it often kicks off a huge debate. People argue about it, lawsuits are filed, and there's always a risk that a future government will just reverse the decision. If you're a company thinking about investing billions of dollars to boost oil production, that kind of uncertainty makes you very nervous. You might hesitate to commit your money or sign long-term deals. This hesitation slows down growth, and again, the promised increase in supply never really happens. Third, we have to remember the global oil market is like a giant interconnected puzzle. An increase in exports from one country doesn't happen in a vacuum. Other major oil-producing nations are watching very closely. Think of it like a group of vendors at a farmer's market. If one farmer suddenly floods the market with cheap tomatoes, the others might decide to sell fewer of their own to keep prices from crashing. In the oil world, if one region starts pumping more, other producers might cut back their own output to balance things out. The end result? The total amount of oil available worldwide might not change at all. And finally, there's the big question of who actually gets paid. This is where it gets really messy. When oil is sold, the money doesn't just go from the buyer to the seller. It passes through a whole chain of entities: producers, refiners, shipping companies, banks, and sometimes even courts. The revenue might be tied up in legal disputes or held in special accounts until arguments are settled. So, even if the oil is flowing, if no one can agree on where the money goes, transactions can grind to a halt. Just issuing a license to sell doesn't magically solve these deep-seated financial and legal tangles. So, the whole idea rests on a very fragile assumption that a small change in policy will smoothly increase supply, lower prices, and benefit everyone, all without causing new problems. But it's a system with many moving parts, and if any single one of them breaks down, the whole thing can fall apart. Let's make this more concrete. How does this connect to your wallet? The average American drives about 13,000 miles a year. If your car gets around 25 miles per gallon, you're buying roughly 520 gallons of gasoline annually. At today's prices, that's easily over $1,000 a year just on fuel. Now, if global oil supply were to increase by a few 100,000 barrels a day, which is a modest amount, it's not going to slash prices in half. But it could lead to a small reduction, maybe a few cents per gallon over time. Let's say it's a 10-cent drop. For the average driver, that's about $50 a year back in your pocket. It's not life-changing, but it's real money. And if you drive a lot for work or have multiple cars in your family, those savings start to add up. However, the opposite is also possible. If the new supply doesn't materialize, or if other countries cut their production, prices could stay exactly where they are. or even go up because of other global events. There's also a ripple effect on the rest of the economy. Energy prices are a key ingredient in inflation. When fuel is cheaper, it costs less to transport everything, from groceries to electronics. This can help ease inflationary pressures across the board. Lower inflation can, in turn, influence bigger financial factors like interest rates on loans and mortgages. So the impact goes far beyond the gas station. It shapes the entire economic climate. Now, let's look at how the market itself reacts. These changes don't affect everyone the same way. When oil prices are lower, it's not great news for oil producers. Companies that focus on drilling and extraction see their profits get squeezed. But on the other hand, refiners, the companies that turn crude oil into gasoline and other fuels, love it. Their main cost, crude oil, just got cheaper. So you often see different parts of the energy sector moving in opposite directions. For investors, energy stocks are part of the broader market. While they aren't the whole story, big shifts in energy prices can definitely influence your overall portfolio performance. This is why you rarely see a single uniform outcome from an energy policy change. It creates winners and losers all across the market. So what should we be watching over the next year or two to see how this is all playing out? There are 4 key things. First, actual production numbers. Are countries just making announcements, or is more oil actually coming out of the ground? Second, look at regional fuel prices. Are prices dropping in areas that are most directly connected to this new supply? Third, watch the other big oil exporters. Are they cutting their own output to keep prices stable? And fourth, keep an eye on the legal and financial side. Are payments for the oil flowing smoothly, or are legal fights getting in the way? Each of these clues will tell us whether these market changes are real and lasting, or just temporary noise. Zooming out, this whole dynamic isn't new at all. For more than a century, access to energy has been a cornerstone of economic and political power. It determines which countries can build industries, run their transportation networks, and withstand economic shocks. In the past, this power came from physically controlling oil fields and pipelines. Today, it's often more subtle. Influence is wielded through financial systems, regulations, and market access. You can prevent a country from cashing in on its natural resources simply by cutting it off from the global banking system. This shows us a critical truth. Just owning a valuable asset is not the same as being able to turn it into real economic value. So for all of us trying to make sense of this, there are a few key takeaways. First, the price you pay for gas is tied to a complex global system, not just what's happening down the street. Second, markets are shaped by rules and access, not just simple supply and demand. Third, energy prices can change very quickly when policies shift. And finally, in the modern world, controlling the flow of money can be just as powerful as controlling the flow of oil. Understanding these deeper mechanics helps explain why things in the real world so often defy our simple expectations. Thanks for watching. This is Wealth Retold. I'll see you in the next one.